We now come to section 4, which is the maturity structure of interest rates. In this context, we need to understand the spot rate curve, the yield curve, and the par curve. But let's make sure we understand the fundamental point. The fundamental point is this, that we can plot maturities on the x-axis, and what we do on the y-axis is look at some form of interest rate or some rate. With the spot rate curve, you have spot rates on the y-axis and maturities on the x-axis. With the yield curve, you will again have maturity on the x-axis and yield on the y-axis. Now let's get into a little more detail. We've talked about spot rates before, but this statement over here elaborates the concept. The spot rate curve plots different maturities on the x-axis and corresponding spot rates on the y-axis. So, for example, let's take the government bond market. You might have a situation where with 1 year maturity, the spot rate is 10%. With a 2 year maturity, the spot rate is 11%, and 3 year maturity, the spot rate is 12%. So this would be the spot rate curve. As we've discussed before, spot rates are yields to maturity or returns earned on zero coupon bonds maturing at the date of each cash flow if the bond is held to maturity. In other words, when you say you have a 2 year spot rate of 11%, that means that there is no intermediate cash flow during that 2 year period. So as the statement says, a 2 year spot rate means that if you invest in a 2 year zero coupon bond, you lock your money in at time 0, you get your money back at time 2, nothing in between, then the yield that you get or the return that you get is called a spot rate. Next we come to the yield curve. The yield curve plots yields of bonds on the y-axis versus maturity on the x-axis. The main difference between a yield curve and a spot rate curve is that the yield curve considers the coupon payments as well. When you think about yield to maturity on a 3-year bond, that yield to maturity considers the intermediate cash flow. In other words, it considers the various coupon payments. So you can have a situation where the yield on a 3-year bond is, let's say, 11.5%. That is the yield to maturity, assuming you are holding a 3-year coupon paying bond to maturity. You don't really need to know this, but generally speaking, if you have an upward sloping yield curve, then the spot rate curve will be above the yield curve. But the larger point here is to recognize that the yield curve plots yields against maturity and the spot rate curve plots spot rates against maturity. The third item here is the par curve. The par curve plots yield to maturity for different maturities, but the bonds are assumed to be priced at par. They also have the same credit risk, currency, tax status, liquidity, periodicity, etc. So conceptually it is similar, and this is not used as much, but we have YTM on the y-axis for bonds which are assumed to be priced at par. I'd say you just remember this definition. All right, the forward curve and the relationship with the spot curve. We have already talked about the spot rate and the spot curve. Now let's talk about the forward rate. And this is very important. It is emphasized in the learning objectives. A forward rate is the interest rate on money borrowed in the future. Forward rates are generally written in the format shown right here, 2y, 1y. Now what does this mean? This is the rate on a 1 year loan starting 2 years from today. What does that mean? Let's say that you are at time 0 over here, and you know that you will need money at the end of year 2, and you will need that money for a 1-year period. You are not going to borrow today, but you might say to the bank that you will need this money after 2 years for a 1-year period. And that is what 2y, 1y means. After 2 years for a 1-year period. The bank might say that the rate here is 10%. This is a forward rate. It is a rate in the future. You also need to understand this concept of an implied forward rate. Implied forward rates are calculated from spot rates. And we'll work through a simple example. Say the 3-year spot rate is 10% and the 2-year spot rate is 9%. What is the implied 1-year rate after 2 years? We need to be able to do this, and I'll show you how. So we draw the same picture I showed you above. This is time 0, this is time 2, this is time 3. We are being asked about the rate over here. Let's say that this rate is X%. X is the unknown. What is given to us? What is given to us is that the 3-year spot rate is 10%. That means that if you invest $1 today, how much will you have after 3 years? What you will have is 1 plus the 10%, or 1.1 cubed. That's how much $1 will become after 3 years. You are also given the 2-year spot rate, which is 9%. You are also given the 2-year spot rate, which is 9%. So how much will you have after 2 years, assuming that you invest $1? You will have 1.09 squared. The implied forward rate is that rate such that if you invest at that rate, you will have 1.1 cubed at the end, because that is the rate implied by the given spot rates. So what you can say is the following: 1.09 squared into 1 plus x equal to 1.1 cube. So this is saying that you invested x, or this percent, and you will get 1.1 cubed. In other words, whether you lock in your money for 3 years or you lock in your money for 2 years, get 1.09 squared, reinvest at this x%, you should get the same amount. This x% then is the implied spot rate. If you solve for x, what you should get is 0.12 approximately, which is 12%. So 12% is the implied forward rate, implied based on the existing spot rates. If we look at the graph now, we again have maturity on the x-axis, and on this we can show both the spot rates and we can show the forward rates. What is the 2-year spot rate? That is given, that is 9%. What is the 3-year spot rate? That is 10%. So our spot rate curve will look something like this. The forward rate over here is higher. What is the forward rate at the end of 2 years? For a 1-year period, we've already shown that that is 12%. For an upward sloping spot rate curve, generally the forward rate will be higher. When interest rates are high in the future, that is what pulls up the spot rates. That's the point you need to learn out of this. Okay, now this example illustrates what we are talking about. Let's say you are given this information. we are looking at YTMs on zero coupon government bonds. When we talk about YTM on zero coupon bonds, is that the spot rate? Yes. So YTM on a zero coupon bond is a spot rate. All right, we are asked to compute 1Y, 1Y. What does that mean? 1Y, 1Y means this. So if this is time 0, time 1, time 2, this is after 1 year, the 1 year rate. So we are being asked to calculate X% over here, this forward rate, and 2Y, 1Y, that is after 2 years. So this is 2, 3, we are being asked to calculate this. How do we do that? Now, there is a subtle difference between this question and what I did earlier. What I did earlier was assumed annual payments. I assumed a periodicity of 1. But what does this do? This is stated on a semi-annual bond basis. I'm going to do the same item that I did on the previous slide, but now on a semi-annual basis. Let's make sure we understand the distinction. So if we are working on a semi-annual basis, 2 years means how many periods? It means 4 periods, because every year has 2 periods. What about for 6 years? How many periods? 6. So how do we come up with this rate X? Let's say X is the rate for this period, a 1 year loan at the end of 2 years. We are given the 3 year rate, 2.891, and we are given the 2 year rate. So both these numbers are going to be used. If you invest $1 over here for 3 years, how much will that $1 become? It will become 1 plus, and then you use the 3 year spot rate, which is actually, do you use this number or half of this number? This is the annualized number. So since we have 2 periods per year, you use half of this number. And you use the decimal or the percent? You have to use the decimal. So you take the decimal number 0.02891 divided by 2, and this has to be raised to the power of 6. Why? Because you have 6 semi-annual periods. This is how much $1 will become at the end of 3 years, which is the same as 6 periods. How much will $1 become at the end of 2 periods? It will become 1 plus, and then you take this rate, 0.02983 over 2, and then this to the power of 4. This is how much you will have at the end of 2 years. But then you need to find this number X. X is the forward rate for 1 year after 2 years. So this number multiplied by 1 plus X over 2 squared should be equal to how much you will have at the end of 3 years. Why did I do X over 2? Because I'm assuming that X is the annualized number. I am doing X over 2 to de-annualize. And why am I squaring? Because here from 2 to 3, year 2 to end of year 3 is 1 year, which is 2 periods. If I solve for X, what I will get is 0.02707, which is 2.7% roughly. Okay, so make sure you can do this, and you can use the same logic to also do the 1y calculation, and there you will get approximately 3.4%. All right, now the last point on this slide, this is an MCQ based question, and there's a high probability of something like this showing up. The investor has a 3-year investment horizon. So this is the investment horizon, and is choosing between number one, buying the 2-year zero. What does the 2-year zero mean? This means the zero coupon bond. Short form is 2-year zero, and reinvesting in another 1-year zero in 2 years. So he's thinking about buying for 2 years and then reinvesting. The other option is buying and holding to maturity the 3-year zero. The investor decides to buy the 2-year bond. Based on this decision, which of the following is the minimum yield to maturity the investor expects on 1-year zeros 2 years from now? So just to paraphrase, the investor could either lock in money for 3 years, or he can lock in money for 2 years and then say that, okay, when I get my money after 2 years, I'll reinvest at this rate. Why would he do this? He would do this because he's thinking that after 2 years, he will get at least this rate. If the investor thought that the forward rate after 2 years will be less than 2.7%, then it would make more sense for him to invest for 3 years and effectively lock in a 2.7% rate over here. But since he believes that the rate over here will be at least 2.7%, that's why he's only locking his money for 2 years, and then hoping that at the end of 2 years, the rate will be 2.7% or more. On this slide, we will look at one application of forward rates. As we've discussed before, implied spot rates can be calculated as the geometric averages of forward rates. And what does that mean? Let's say you are given this information. What does 0y, 1y mean? If this is 1.88%, this means that the current interest rate is 1.88%. In other words, time 0, time 1, when you invest money today, the rate that you are getting is 1.88%. What was 1y mean? So that is after 1 year, the interest rate for 1 year. So the interest rate for this period, this is a forward rate, this is 2.77%. And then 2y, 1y means that this period. So after 2 years, the interest rate for one period is 3.54%. Now the question is, what is the 2-year spot rate? These numbers are forward rates. So actually this is the current interest rate, 1.88. 2.77 is a forward rate. So if I ask you what is the 2-year spot rate, let's say the 2-year spot rate is X. Or more simplistically, I'll write it as S2. So if I say 1 plus S2, S2 means the 2-year spot rate. So 1 plus S2 squared, remember S2 is an annualized number or a 1-period number. This is equal to 1 plus 0.0188 multiplied by 1 plus 0.0277. Where is this 0.0188 coming from? That's just the decimal form of this. And this is the decimal form of 2.77. In other words, if you take $1, invest it for this period, and then that money is invested at 2.77, you get this much money. This should be the same as investing for 2 years at the 2-year spot rate. So what is 1 plus S2 then? 1 plus S2 is the product of these two raised to the power of 1 over 2. That is a geometric mean. How will you come up with 1 plus S3? 1 plus S3 cubed, and S3 is the 3-year spot rate. This would equal 1 plus this number times 1 plus this number times 1 plus this number. And then 1 plus S3 would be the product of those three raised to the power of 1 over 3. So just to make sure you get it, 1 plus S3 would be the product of the three numbers that we just talked about raised to the power of 1 over 3, which is the geometric mean. So this statement then should make sense. The implied spot rate is the geometric average of the forward rates. So if you are given forward rates, how can you come up with the arbitrage free price of a bond? Remember, to come up with the arbitrage free price of a bond, you take each cash flow and then discount at the appropriate spot rate. Given the forward rates, you can compute the spot rates, and then you can use the spot rates to discount each cash flow. All right, so this is fairly straightforward.